You know, when you walk into a beautifully curated retail space, let's say you're running your hand over this like ridiculously comfortable linen sectional, or you're inspecting a high-end forged steel chef's knife, there's this carefully constructed illusion of effortless serenity.
Oh, absolutely. The lighting is dialed into the perfect color temperature. The aesthetic just sort of washes over you.
Right. You are meant to feel entirely calm, completely detached from the chaos of the outside world.
Which is, of course, a highly engineered psychological state. I mean, the absolute last thing they want you to think about is the thousands of moving parts, the brutal global shipping logistics, or the raw, cutthroat corporate strategy that was required to place that specific linen sectional in front of you at that exact moment.
Yeah, exactly. Retail at that level is essentially a swan gliding across a lake. You see the grace above the water, but you don't see the frantic, churning mechanical effort happening beneath the surface.
For sure.
And the deeper you look at the quarterly earnings data, the more you realize that perfectly styled living room display is actually the spoils of an intense, highly calculated operational war.
It really is.
So, welcome to Talk Tickers, where we translate Wall Street jargon into actionable insights. Today, for you, the listener, we are going to dissect the front lines of that war. We are unpacking the Q1 2026 earnings call for Williams Sonoma Inc., ticker symbol WSM.
And, whether you're managing a supply chain, analyzing consumer behavior, or just intensely curious about how the modern economy functions when the pressure is dialed up, the mechanics of this specific quarter are an absolute masterclass.
They really are. So let's start with the broader context, because that's what makes this specific deep dive so compelling.
Right. We're looking at a 70-year-old retail giant navigating a macroeconomic environment that is, by all accounts, openly hostile to their core business model. I mean, the stakes are incredibly high here.
And the strategies they're employing, they go far beyond the typical retail playbook of just, opening new stores or slashing prices to move inventory.
Yeah, exactly. Which brings us to the central mystery we are going to unravel today.
Right, the hook. So here's the crazy part. In the first quarter of 2026, the broader home furnishings market didn't just stall, it shrank.
Like actively declined in the low single digits?
Exactly. People were simply buying less furniture. I mean, the housing market was essentially frozen by the lock-in effect of legacy interest rates.
Right. People weren't moving. And if you aren't moving, you aren't buying new dining tables or outfitting new living rooms.
Exactly. And yet, amidst that industry-wide contraction, Williams Sonoma posted heart-pounding, accelerating growth numbers.
It's wild.
It is. We need to figure out how they pulled off a massive, undeniably huge win while almost everyone else on the playing field was losing ground.
To understand the magnitude of that divergence, we have to start with the raw data, like the headline numbers.
Right, let's look at the scoreboard.
So as reported by their CFO, Jeff Howey, and CEO, Laura Alber, the data tells a very specific story about operational leverage. In Q1, their net revenues hit $1.81 billion.
Okay.
Their earnings per share, or EPS, came in at $1.93.
Which is, what, a 4% increase from the $1.85 they posted in the same quarter last year, right?
Exactly, up 4%. But, the metric that really signals the health of the underlying engine is their operating margin, which kept 16.2%.
Wait, 16.2%? That wasn't just solid. That significantly beat Wall Street's expectations.
Oh, massive.
Which is mathematically wild when you factor in the macroeconomic headwinds. I mean, they were absorbing higher international fuel costs, which pressures freight, and a complex web of incoming international tariffs all at the same time.
Right. Retaining a 16.2% operating margin in a deflationary revenue environment for the sector, I mean, it means they are leveraging their fixed costs with brutal efficiency.
Okay, so the margin expansion is impressive, but let's talk about the top-line growth metric. The one that really separates them from the pack right now.
You mean the comps?
Yeah, the comps. Can you explain that for the listener?
Yeah.
They posted a positive 4.8% comparable brand revenue growth, or comp growth.
Right. So for anyone tracking retail, you know that a comp measures the health of the existing business. It's not just growth from opening new stores, it's comparing sales from stores that have been open for at least a year.
Got it.
And posting positive comps in a shrinking market is structurally anomalous.
Because it's a zero-sum environment. I mean, if the overall pie is literally shrinking, if there are fewer dollars being spent on home furnishings across the entire economy, a 4.8% organic growth rate means they aren't just finding new money.
No, they are aggressively, systematically taking market share away from their competitors.
It's like winning a sailboat race when there's absolutely no wind on the water.
That's a great way to put it.
Right. You can only pull ahead by having a vastly superior hull design or a crew that outrows the competition.
It is a pure market share land grab, and it's driven by a highly bifurcated consumer environment. Jeff Howey was very explicit about this on the call.
What do you say?
Well, they are accelerating their market share gains because their portfolio is positioned to capture the specific consumer demographics that actually still have discretionary income.
Okay, so while lower-tier furniture retailers are getting crushed by inflation, squeezing the middle-class consumer, Williams Sonoma's higher-end demographic is still spending.
Exactly. But more importantly, they're capturing that spend efficiently.
And the ultimate proof of that efficiency is their free cash flow. I mean, we always talk about actionable takeaways for investors here on Talk Tickers, and they executed what I can only describe as a massive capital return flex this quarter.
A huge flex.
Yeah, they didn't hoard their cash defensively, which is what you typically see companies do when the macro environment gets choppy. In Q1 alone, they returned $373 million to their investors. Right. We are talking about $288 million in aggressive share buybacks and $85 million in dividends.
Yeah.
And that dividend payout represents a 15% increase year over year.
The historical context of that dividend increase is crucial for understanding the management team's psychology, though.
How so?
Well, fiscal 2026 marks their 17th consecutive year of increasing their dividend payouts.
17 years straight.
Yeah. That is a level of capital allocation consistency that signals deep structural confidence to the institutional market.
I mean, you do not commit to a structurally higher dividend payout for 17 years straight unless your internal forecasting models show extreme resilience in your ability to generate free cash flow.
Exactly. Regardless of whether the housing market is booming or busting.
It's a massive signal of underlying financial health. So the scoreboard is undeniably green. Margins are expanding, they're buying back stock, and they're growing organically while the industry shrinks.
Right.
But the mechanics of how they are doing this require us to look past the consolidated corporate numbers. I mean, Williams Sonoma isn't a monolith.
No, not at all.
It's a carefully constructed portfolio of distinct brands. And analyzing the strategy brand by brand reveals a fascinating playbook for surviving a retail downturn. Let's dive into the story behind the numbers.
So the absolute standout performer in this portfolio, the engine really driving this quarter's beat, was West Elm.
Oh, yeah.
They posted an explosive 8.5% comp growth.
An 8.5% comp for a mature legacy furniture brand in a down market is just staggering.
It really is.
And Laura Albert attributed a significant portion of this momentum to what she termed brand heat. She specifically pointed to their collaboration with Emma Chamberlain as a primary catalyst.
Right. Now, for the uninitiated, Emma Chamberlain is a massive Gen Z cultural force.
Yeah, she's a YouTuber, a fashion icon, an influencer with immense reach. But wait, the economics of pairing a legacy furniture brand with a Gen Z influencer go far beyond just buying a sponsored Instagram post, right?
Oh, completely. The underlying mechanic here is all about customer acquisition cost, or CAC, and lifetime value, LTV.
Okay, break that down for me.
Well, furniture is traditionally a very slow-moving, low-frequency purchase category. The average consumer buys a high-end sofa maybe once every 7 to 10 years.
Makes sense.
So the cost to acquire a new customer through traditional performance marketing, like, Google ads or Facebook targeting, has skyrocketed.
So what did West Elm do?
West Elm realized that to lower their CAC, they needed top-of-funnel cultural relevance. By collaborating with Emma Chamberlain, they aren't just paying for eyeballs, they are transferring her cultural equity directly onto their products.
And they didn't just slap her name on a generic mid-century modern credenza. I looked at the line. They co-designed distinctive, story-driven products that actually resonated with a younger, highly engaged audience.
Yeah, and Albert noted that this collaboration brought a hip feeling and a sense of surprise back to the shopping experience.
Right. It bypassed the traditional, often sterile furniture shopping process and injected a sense of fashion and urgency into the purchase.
It creates a lower funnel conversion for a demographic that might otherwise completely ignore legacy home brands until they're much older. They are acquiring the Gen Z consumer at the entry point of their independent purchasing life cycle.
That's incredibly smart. But the critical piece of the West Elm story this quarter wasn't just online hype. It was their physical execution, right? West Elm's brick-and-mortar stores were a massive highlight.
Yeah, which feels counterintuitive in the age of digital dominance.
Seriously.
But they saw customers returning to physical stores in large numbers, driven by improved in-stock availability and a much stronger visual presentation of new inventory.
They are actually planning to open 5 new West Elm stores in 2026, which is a massive capital expenditure commitment to physical retail.
The data supports that commitment, though. Omnichannel customers, those who engage with the brand both online and in physical stores, they typically spend 2 to 3 times more than single-channel customers.
Wow, 2 to 3 times more?
Yeah. I mean, you can generate all the digital brand heat in the world with an influencer collaboration, but if a customer walks into a store and the shelves are bare, or the visual merchandising looks tired, the conversion funnel collapses.
Right, the vibe is ruined.
Exactly. West Elm fired on both cylinders. They had the top-of-funnel marketing excitement perfectly synchronized with bottom-of-funnel operational excellence in the physical stores. The inventory was there, and the presentation matched the digital promise.
Okay, so West Elm is playing the role of the cultural vanguard, pulling in the younger demographic.
Right.
But contrast that with the namesake brand, Williams Sonoma itself.
Right.
This is their 70th anniversary year. It is incredibly rare for a 70-year-old retail brand to not just maintain relevance, but to actually accelerate.
Yeah, they posted a very solid 5% comp growth.
The mechanics behind a heritage brand growing in this environment are entirely different from West Elm's influencer playbook, I assume.
Completely different. With the Williams Sonoma brand, the strategy is anchored in dominating the high-end culinary space and fiercely protecting their exclusivity.
Okay.
In a world where you can buy almost anything on Amazon with one-click shipping, Williams Sonoma has to offer products that simply cannot be found anywhere else.
Right.
Albert highlighted their relentless pipeline of proprietary in-house designed products and strict market exclusives.
Yeah, I saw that. If you want the specific Sam the Cooking Guy pizza oven engineered by Green Pan, or the exclusive collaboration pieces with world-renowned interior designer Kelly Wersler, you have to buy them directly through the Williams Sonoma ecosystem.
Exactly. They are essentially building a moat of proprietary merchandise around the brand.
And they are elevating that merchandise through experiential retail.
Yeah.
I mean, they aren't functioning as a passive warehouse for cooking tools. They're activating the physical space.
Yeah. They host skill series culinary classes in their stores. They offer highly personalized concierge-level registry appointments.
Which fundamentally changes the customer relationship. Like, if you take a sourdough baking class in Williams Sonoma store using their exclusive Dutch ovens and specific spatulas, the probability that you purchase that exact equipment from them skyrockets.
Oh, for sure. You are buying the experience and the expertise, not just the physical object.
Right. They even expanded this lifestyle positioning through a collaboration with Oakville Grocery. That's the iconic, oldest, continuously operating grocery store in California's Napa Valley.
The Oakville Grocery partnership is a perfect distillation of selling a comprehensive lifestyle rather than just a product. It ties the Williams Sonoma brand directly to the heritage, community, and prestige of the Napa Valley food and wine scene.
And, that Napa connection actually led to one of the most human, revealing moments on the entire earnings call.
Oh, I know exactly what you're talking about.
Right. Right in the middle of this dense, highly technical financial briefing, surrounded by talk of operating margins, global freight pressures, and macroeconomic headwinds, Laura Albert just casually invites the Wall Street analysts to call her if they're going to be in Napa for the Bottle Rock Music Festival that weekend.
It was a fascinating tonal shift.
It really was.
But, it's not just idle chatter. It is highly effective investor relations.
How do you mean?
Well, it projects a supreme level of calm and control. I mean, a CEO who is panicked about their balance sheet or overwhelmed by supply chain crises does not invite analysts to call her from a music festival.
That is a very good point.
It subtly reinforces the brand's identity, hospitality, entertaining, and a premium lifestyle while simultaneously projecting unshakable corporate confidence.
Exactly. It basically says, the machine is running so smoothly, I have time to talk about Bottle Rock.
Yep.
Okay, so we have the Gen Z momentum at West Elm and the 70-year heritage lifestyle mode at Williams Sonoma. Now we need to examine the bedrock of the portfolio, the sheer volume driver Pottery Barn. Right. The numbers here were more muted. Pottery Barn was up 1%, though the Pottery Barn Kids and Teen divisions were up 4.5%. When you dig into the commentary, there's a massive strategic pivot happening inside the Pottery Barn ecosystem.
Yeah, Albert was remarkably candid about the need for a course correction at Pottery Barn.
Oh, yeah.
She acknowledged that they are executing a deliberate return to the brand's traditional aesthetic roots. Over time, large brands can suffer from aesthetic drift.
Right. They try to chase macro trends and risk alienating their core demographic.
Exactly. The pivot here involves realigning both their product design and, crucially, their marketing and photography back to the classic, comfortable, traditional aesthetic that made Pottery Barn an icon in the first place.
And to execute a pivot of that magnitude, they announced a major changing of the guard. Jennifer Keller, a 29-year veteran of the company, is being promoted to president of Pottery Barn, replacing Monica, who is departing after 26 years.
And, replacing a leader with over 2 decades of tenure with someone who has almost 3 decades of institutional memory is a very specific strategic choice.
Right. They didn't bring in an outsider from a fast fashion brand to shake things up.
No. Keller has a proven track record of incubating internal brands and possesses deep expertise in merchandising and e-commerce. They are relying on profound institutional knowledge to guide this aesthetic reversion and accelerate that 1% growth back to historical norms.
Makes sense. Meanwhile, the 4.5% growth in the kids and teen sector highlights a different tactic: the aggressive use of licensing and external collaborations.
Right.
They specifically called out partnerships with highly stylized brands like Love Shack Fancy and influencers like Chris Loves Julia.
Yeah, they are using these collaborations to inject fresh assortments into the lineup and constantly acquire new cohorts of parents who follow these specific designers online.
Which is smart. And actually, the kids and teen division serves as a microcosm for the broader, highly sophisticated strategy that Williams Sonoma employs across its entire corporate structure.
Absolutely. They operate the parent company almost like a venture capital incubator.
Yeah.
They do not rely solely on their massive legacy names to drive all future growth.
This was easily one of the most structurally fascinating parts of the transcript. They actively cultivate what they call white space emerging brands.
Right.
For instance, they recently launched their 10th brand, Dorify, which is hyper-targeted at dorm rooms and small space living for the next generation.
Then you have Rejuvenation, a brand focused on premium home hardware, lighting, and project-led renovations.
And they did well, right?
Oh, Rejuvenation posted double-digit growth this quarter. Albert stated on the call that they internally view Rejuvenation as their next billion-dollar brand.
Wow.
Which is incredible considering it currently operates out of only 13 physical retail locations.
That's wild. You also have Mark & Graham, another double-digit growth engine, completely zeroed in on personalized gifting, monogrammed leather bags, customized accessories for weddings and graduations.
Yep.
And their newest venture, Green Row, which focuses on sustainable, vintage-inspired design, and just opened its flagship physical store in Soho.
And the strategic brilliance of this incubator model lies in the shared back-end infrastructure.
Right.
When Williams Sonoma launches a new brand like Green Row or acquires a concept like Dorify, they don't have to build a new supply chain from scratch.
Yeah, they don't have to negotiate new international freight contracts or build new warehouse management software.
Exactly. They simply plug the new aesthetic front end into their existing world-class global logistics network. This drastically lowers the capital expenditure required to launch new brands and massively accelerates their path to profitability.
But I want to push back on this multi-brand strategy because on paper, it sounds like a recipe for internal warfare.
Oh, so?
Well, if you are managing 10 different home goods brands under one corporate umbrella, how do you avoid catastrophic cannibalization? I mean, if a consumer has a budget of $2,500 for a new living room setup, how does corporate ensure that West Elm, Pottery Barn, and Williams Sonoma Home aren't just aggressively spending marketing dollars to fight each other for that exact same customer?
It is the inherent risk of any large portfolio model, but they mitigate that risk through incredibly surgical differentiation.
Okay.
They aren't just varying the price points, they are targeting distinct life stages and fundamentally different aesthetic sensibilities. They are building a walled garden where the customer naturally migrates from one brand to the next as their life evolves, rather than choosing between them at the same moment in time.
Okay, walk me through the mechanics of that life cycle migration. How does it actually play out for the consumer?
Think about the chronological journey of their target demographic. When a young adult is heading off to college, the corporate ecosystem captures them with Dorify. It's accessible, trend-driven, and designed for small spaces. A few years later, when they secure their first apartment and want a more sophisticated, modern, slightly eclectic aesthetic, they graduate to West Elm. When they move to the suburbs and need durable, classic, large format furniture for a growing family, they transition to Pottery Barn.
And it continues into niche needs. Like when they undertake a major kitchen or bathroom renovation, they are routed to Rejuvenation for the hardware and lighting.
Exactly.
When they need to purchase groomsmen gifts for a wedding, the ecosystem captures that spend through Mark and Graham.
Precisely. The aesthetics are intentionally siloed. A customer looking for West Elm's mid-century, modern, highly textured vibe is fundamentally repelled by Pottery Barn's rustic, traditional farmhouse aesthetic, and vice versa.
Right, they aren't cross-shopping those brands for the same room.
No. By covering the entire spectrum of design sensibilities and life stages, Williams Sonoma ensures that regardless of how the consumer's taste evolves over a 50-year purchasing life cycle, their discretionary income remains locked inside the corporate ecosystem.
Okay, so the aesthetic differentiation is dialed in, the influencer marketing is lowering acquisition costs, and the portfolio strategy is effectively capturing the lifetime value of the customer. But here's the gritty reality check.
Let's hear it.
Generating a beautifully rendered, photorealistic digital ad for a 300-pound linen sectional is relatively easy.
Sure.
Physically moving that 300-pound sectional from a manufacturing facility in Vietnam across the ocean through a port onto a truck and up 4 flights of stairs into a Gen Z influencer's walk-up apartment without damaging the item or destroying your profit margins is an entirely different universe of complexity.
It is.
Which brings us to the most vital, unglamorous part of this deep dive. Let's look at the supply chain logistics.
This is the operational inflection point where a good retail brand either becomes a great company or slowly bleeds to death. Jeff Howey made it abundantly clear on the call that Williams Sonoma views their supply chain not as a traditional cost center, but as a primary competitive weapon.
Yeah, he dropped a statistic that genuinely forces you to reevaluate the scale of this company.
Yeah.
He stated that Williams Sonoma successfully executes 2.4 million in-home deliveries every single year.
Which is just great.
If you break down the math on that, they are coordinating roughly 7,000 large format in-home furniture deliveries every single day.
And, the sheer density of that routing network is their primary defense against macroeconomic inflation.
How so?
Consider the current freight environment. Global oil prices are elevated, which severely pressures both international ocean freight rates and domestic trucking costs. If you are a smaller boutique furniture retailer moving a few hundred couches a month, those fuel surcharges destroy your margins.
Right.
You have to pass the cost to the consumer, which kills demand.
But because Williams Sonoma has the volume of 7,000 deliveries a day, they possess massive leverage.
Exactly.
They can negotiate highly favorable, long-term contracted rates with ocean carriers. Domestically, they can utilize highly sophisticated route optimization software. When a delivery truck leaves their distribution center, it isn't zigzagging across a state to deliver 2 items.
No, the route density ensures that truck is hitting 10 stops in a tight geographic radius, mathematically minimizing the fuel burned per delivery. They're actively mitigating the impact of global inflation through the sheer gravity of their operational scale.
And their internal metrics for success on those routes are ruthless. Howie discussed their focus on the perfect order metric.
Right, the perfect order.
It's a binary measurement. Did the delivery arrive inside the promised time window? Was the product completely damage-free? Did the white glove delivery team assemble it correctly and place it exactly where the customer requested?
Yeah, they require the customer to sign off and often take photographic evidence of the completed setup to prove the service was flawless.
Because the unit economics of a failed furniture delivery are catastrophic. I mean, if you deliver a damaged $3,000 sofa, you don't just lose the profit margin on that item.
Right, you have to pay the reverse logistics cost to retrieve the damaged item.
Exactly. Pay the freight to ship a replacement, absorb the cost of the damaged inventory, and most importantly, you likely permanently lose the lifetime value of that customer because their experience was miserable.
Which perfectly transitions into one of the most highly technical, accounting-heavy moments of the earnings call. Howie noted that their gross margin actually benefited by 50 basis points this quarter due to a lower shrink accrual.
Okay, wait. For the listener who isn't a forensic accountant, we need to break down the mechanics of a shrink accrual and how it magically generated a 50 basis point boost to their bottom line profitability this quarter.
Explain shrink accrual to me like I don't have a CPA.
All right. To understand the accrual, we first have to understand the reality of shrink in physical retail. Shrink is the industry term for any inventory that disappears from the balance sheet without generating revenue.
It encompasses retail theft, administrative errors where inventory is lost in the digital management system, and critically for furniture, damage. A forklift driving a prong through a pallet of mirrors in a distribution center is shrink.
It's the inevitable friction and loss of moving millions of physical objects around the globe.
Exactly. Now, because a multinational corporation cannot physically halt operations to count every single spatula and sofa every single day, the accounting department relies on an accrual system.
Right.
Based on historical data, they forecast a specific percentage of inventory that they expect to lose over the course of the year. They take that estimated financial loss and bake it into their financial models as a negative buffer.
So they set the money aside on the ledger, assuming the worst.
Correct. But periodically, usually at the end of a fiscal year or a specific quarter, they execute a massive physical inventory count across their warehouses and retail fleet to see what they actually have. This reconciliation process is called truing up.
Truing up, okay.
What Jeff Howey revealed is that when WSM executed their true-up in Q1, they discovered that their actual real-world shrink was significantly lower than the negative buffer they had modeled for.
Meaning their supply chain software, their warehouse management protocols, and their delivery teams were operating with far more precision than the accountants had predicted. They didn't break or lose nearly as much inventory as historical averages suggested they would.
And because they had over-accounted for that anticipated loss, accounting rules dictate that they reverse that accrual.
Oh, wow.
Yeah, that reserved capital flows directly back onto the income statement as a tangible benefit, structurally boosting their gross margin by 50 basis points. It is one of the clearest examples you will ever see of tight, disciplined warehouse and logistics management translating directly into pure bottom-line profit.
It's a phenomenal operational win, but that massively scaled supply chain isn't just delivering to residential apartments and suburban homes. And this brings us to what I consider the most fascinating, almost hidden pillar of their entire corporate structure, the B2B, or business-to-business juggernaut.
The B2B division is rapidly becoming the foundational ballast of the entire company. The growth metrics reported for this quarter were staggering.
Overall B2B growth was up 13.7% year over year. Management confirmed this was officially the largest, most lucrative B2B quarter in the history of the enterprise.
Yeah.
They segment this division into two distinct channels, trade and contract. Trade grew by 9%, while the contract side posted an explosive 22% growth rate. Let's dissect the operational differences between these two revenue streams, starting with trade.
So the trade division functions essentially as a subsidized ecosystem for independent interior designers. Imagine a local high-end interior designer who has been contracted to furnish a client's newly constructed 5-bedroom home. Rather than the client purchasing the furniture at retail prices, the designer utilizes their WSM trade account to procure the entire catalog across West Elm, Pottery Barn, and Rejuvenation at a specific trade discount.
And the economics of this are brilliant for Williams Sonoma. They essentially outsource their sales and customer acquisition to an army of independent designers.
Exactly.
The designer acts as a fiercely loyal, recurring revenue channel, continually funneling their clients' capital directly into the WSM ecosystem. And as management noted on the call, they don't even have to compete on price promotions or discount codes in the trade channel.
Because the designer isn't optimizing for the absolute lowest price, they are optimizing for reliability. The designer's professional reputation is on the line. They trust Williams Sonoma to actually manufacture the custom 12-person dining table and deliver it flawlessly before the client's massive holiday dinner party.
Right.
They are competing purely on service and logistical certainty.
But as impressive as the trade division is, the contract side, which drove that 22% growth, operates on an entirely different scale. This isn't furnishing a 5-bedroom house. This is massive, high-stakes commercial volume.
Oh, yeah.
This division is outfitting massive luxury hotels, corporate headquarters, international stadiums, and sprawling real estate developments.
The marquee projects they secured and announced on this call underscore their dominance in the commercial space. They are the exclusive furnishing partner for the Delano in Miami, the Bernardus Resort and Spa, and the Capital One Arena.
Wow.
They are executing multi-property rollouts for massive national real estate developers like Greystar. They are even handling the commercial outfitting for the upcoming U.S. Open tennis tournament.
The mechanical complexity of furnishing a 300-room luxury hotel like the Delano is mind-bending. You're dealing with commercial-grade fire retardant standards, extreme durability requirements, and unforgiving construction timelines. If you are the lead developer on a $500 million resort project, you cannot afford for 300 beds to arrive 3 weeks late, or for the lobby lounge chairs to be damaged in transit. Every day the hotel can't open is millions of dollars in lost revenue. The developer needs absolute, ironclad logistical certainty.
Which is exactly why Laura Alber emphasized that WSM is winning these massive multi-million-dollar contracts. She explicitly stated that their designs to deliver capabilities are difficult to replicate.
Because smaller competitors just can't keep up.
Right. Smaller commercial furniture manufacturers simply do not possess the global supply chain infrastructure to guarantee delivery on that scale. WSM leverages the exact same 7,000 delivery a day logistics network they use for their retail operations to provide unmatched certainty to their commercial clients.
They even won Best in Show at the Hospitality Design Expo in Las Vegas this year, which effectively cements their reputation as the premier commercial outfitter.
Looking at the interplay between their retail operations and this massive B2B division, I think the best way to conceptualize it is as a massive corporate flywheel.
Okay, explain the flywheel.
So the beautiful retail storefronts, the stunning West Elm on the corner, the aspirational Williams Sonoma catalog in your mailbox function as a self-funding marketing brochure.
Right.
They establish the brand prestige, the aesthetic desirability, and the cultural relevance in the mind of the consumer. That immense retail brand equity then subsidizes the acquisition cost for the highly lucrative B2B engine.
Ah, I see.
The real estate developer wants to put West Elm furniture in their luxury apartment building because the retail stores have already convinced the prospective tenant that West Elm is a premium, desirable brand.
It is a perfectly calibrated, subsidized ecosystem. The retail operations provide the cultural halo and the supply chain scale, which allows the B2B division to secure the massive, highly predictable commercial contracts.
Exactly.
And those long lead commercial contracts provide a massive foundation of revenue stability that completely insulates the broader company from the day-to-day cyclicality of a retail consumer deciding whether or not to buy a single throw pillow.
It's brilliant architecture.
It really is. And speaking of the architecture running beneath the surface, there was a deeply fascinating exchange during the Q&A segment of the earnings call, where management detailed exactly how they are integrating the biggest technological paradigm shift of the decade into their 70-year-old business. Let's examine how Williams Sonoma is deploying artificial intelligence.
This was not your typical corporate lip service to a trending buzzword. The Chief Technology Officer, Samir, provided a highly granular breakdown of how they are actively deploying machine learning and generative AI across the entire life cycle of the customer journey, from initial discovery all the way down to the deepest layers of supply chain routing.
Right. He structured the AI deployment into 3 specific operational theaters. The first is customer-facing AI. They have developed a proprietary Williams Sonoma culinary assistant.
Right.
Now, normally when a consumer interacts with a retail chatbot, it is a deeply frustrating experience. It's usually just a basic decision tree designed as a deflection tool to prevent the customer from calling a human support agent. It usually just spits out a link to an FAQ page.
Oh, for sure.
But Samir detailed how this assistant is engineered to be an active revenue-generating sales mechanism.
The intelligence of the deployment lies in its contextual awareness. If a customer is browsing the site and asks the AI, what specific type of pan do I need to achieve a professional sear on a steak using an induction stove? The AI doesn't just return a generic search result for cast iron.
Okay.
It analyzes the customer's query, curates a highly specific selection of Williams Sonoma proprietary cast iron skillets, explains the metallurgical reasons why they are optimized for magnetic induction, and provides a frictionless, direct path to the checkout cart.
Wow.
It acts as an elite, deeply knowledgeable digital sales associate, driving the customer directly to conversion.
Then there's the second theater, Design AI. They have integrated generative AI directly into their room planner tool. Samir explained how this technology allows customers to visualize an entire room design with what he called photorealistic quality.
Right.
And the business imperative behind this tool is all about overcoming what they refer to as the confidence barrier.
The confidence barrier is arguably the single largest friction point in the economics of furniture retail.
Yeah, purchasing a $3,500 sectional sofa is a massive financial commitment, but it is an equally massive spatial and aesthetic commitment.
Absolutely.
The consumer is plagued by anxiety. Will the dimensions actually fit my living room? Will that highly specific shade of burnt orange velvet horribly clash with the undertones of my existing hardwood floors? Will it make the room feel claustrophobic? This paralyzing doubt is the primary driver of digital shopping cart abandonment in the furniture sector.
But I want to inject a philosophical pushback here.
Go for it.
Because we are talking about automating the most intimate spaces in a person's life. Interior design is inherently deeply personal. It relies on human warmth, tactical memory, and emotional resonance.
Right.
If we interject a machine learning algorithm into the center of that creative process, don't we risk homogenizing our environments? Are we just going to end up with millions of American living rooms that look exactly the same because an AI optimized them for maximum algorithmic trendiness?
It's a very valid cultural concern, and if deployed poorly, that is exactly what happens. But Samir's specific framing addressed this. WSM is utilizing AI not to replace the human designer's intuition, but to manage proprietary spatial data and eliminate geometric anxiety.
Okay.
The AI isn't dictating the aesthetic choices. It is facilitating the visualization of the user's specific, deeply personal preferences. It takes the user's messy, creative vision and renders it with mathematical, photorealistic precision.
I see.
It doesn't sterilize the design. It gives the consumer the psychological bravery to finalize the $3,500 purchase. Because the AI is mathematically proven that the sectional will, in fact, fit perfectly next to their bay window without blocking the hallway. It systematically removes the doubt that kills the sale.
It's essentially democratizing the capability of a master architect instantly sketching your idea so you aren't making a financially disastrous mistake.
Exactly.
And the hidden economic benefit here is return rates. If the AI visualization gives the customer the confidence that the item fits perfectly, it drastically lowers the return rate. And as we discussed earlier, avoiding the reverse logistics cost of shipping a massive sofa back to the warehouse saves millions of dollars in operating margin.
Exactly. The final theater Samir detailed was back-end AI. They are deploying machine learning algorithms deep within their supply chain to identify overlapping opportunities in transportation routing and warehouse productivity.
Right.
The AI is constantly analyzing millions of concurrent data points, real-time truck locations, warehouse inventory levels, micro fluctuations in regional fuel prices, traffic patterns, and executing micro-efficiencies and route adjustments that a human logistics manager could never calculate manually. It is the digital brain constantly optimizing that 7,000 delivery a day physical machine.
Which makes the logistical execution of this exact earnings call highly ironic.
Oh my God, yeah.
Right after the executive team finished detailing this hyper-advanced, multi-million-dollar generative AI deployment, they opened the floor for the Q&A session.
Yeah.
An analyst from JPM attempted to ask a complex financial question, and the conference call audio was echoing so severely with such a massive feedback loop that he stopped and said it sounded like a Pink Floyd concert.
It was a profoundly grounding moment of corporate reality.
It truly was. Laura Alber had to jump in, apologize to the analyst, and explain that their telecom partner was desperately trying to fix the audio bridge.
It is the ultimate paradox of modern corporate America. A company can deploy generative AI that mathematically renders the spatial dynamics of a velvet armchair in milliseconds, and they can coordinate a global fleet of cargo ships to seamlessly bypass international trade tariffs. But here we are in the year 2026, and a multi-billion-dollar enterprise still cannot figure out how to stop the audio echo on a basic conference call.
The friction of basic human technology remains a constant.
It really does. So let's synthesize their position. They have the advanced technological infrastructure. They are executing a highly disciplined multi-brand portfolio strategy. Their B2B commercial flywheel is generating massive volume. And they absolutely crush the Q1 expectations despite the broader market contracting.
Right.
So the ultimate question is, what did the executive team tell Wall Street to expect for the remainder of the fiscal year? This brings us to the final piece of the puzzle, management guidance and the macroeconomic road ahead.
The guidance section was arguably the most strategically revealing portion of the entire transcript. In the mechanics of the stock market, when a company delivers a massive beat in the first quarter, meaning their revenue and earnings significantly outperform the consensus estimates of Wall Street analysts, investors almost universally expect the management team to raise their financial guidance for the rest of the year.
Right, it's the standard playbook.
But WSM made a very deliberate contrarian decision. Despite the massive Q1 beat, they reiterated, meaning they kept exactly the same, their annual guidance from Q4. They flatly refused to raise their financial forecasts.
It's a hold steady strategy that telegraphs immense caution. Let's break down the specific numbers they're committing to.
Okay.
For the full year, they expect net revenue comps to land somewhere between a 2% decline and a 6% positive growth rate. They expect their operating margin to remain incredibly strong, between 17.5% and 18.1%. And they are modeling for $275 million in capital expenditures, noting that 95% of that capital is going directly into physical retail store improvements and further supply chain tech integration.
But the refusal to raise that guidance in the face of such a strong Q1 initially causes anxiety for institutional investors. Laura Alber had to be incredibly precise about the why behind this apparent conservatism.
And what was her reasoning?
Her reasoning was predicated entirely on extreme, unquantifiable external uncertainty. She explicitly stated to the analysts that WSM's internal financial models are not assuming a meaningful recovery in the housing market for the remainder of the year.
Which is a remarkably sober, almost pessimistic baseline for a furniture executive.
Yeah.
I mean, the entire home goods industry is historically tethered directly to the velocity of the housing market. People buy new dining sets when they close on a new house.
Exactly.
By explicitly refusing to bank on a housing recovery, WSM is essentially telling Wall Street, we are operating under the assumption that the consumer is locked in place, and we have to figure out how to grow our margins even if nobody moves for the rest of the year.
And the macro headwinds she cataloged to justify this caution are intense. She pointed to geopolitical instability, ongoing global conflicts disrupting shipping lanes, volatile fuel prices, and the paralyzing effect of sustained high interest rates on consumer credit. It is essentially a radar screen saturated with red storm clouds, but the most specific, financially quantifiable storm cloud they detailed was the reality of incoming international tariffs. Jeff Howey provided a deep technical dive into how tariffs are actively hitting their balance sheet right now.
And the numbers are not theoretical, they are substantial. Howey revealed that WSM currently has $60 million in incremental, newly applied tariff costs embedded directly into their $1.46 billion of standing inventory.
Right.
We need to translate the accounting mechanics of this for the listener, because it dictates exactly how this company will perform in the coming months. How does an international tariff actually flow through a company's financial statements? And why did Howey emphasize that the impact would be front half weighted due to weighted average costing? What are the actual mechanics of that pain?
Let's trace the life cycle of a tariffed item. When Williams Sonoma procures a massive shipment of goods from an overseas manufacturing partner, say a fleet of dining chairs from Asia, and brings them through a U.S. port, they are levied a tariff, which is essentially a federal tax on the import.
Okay.
Now, critically, that tax is not recorded as an immediate expense on the income statement the day the ship docks. Instead, the cost of that tariff is capitalized. It is added to the total intrinsic value of the inventory sitting in the warehouse.
So the tax is physically attached to the chair. That $60 million in extra governmental taxes is literally sitting on shelves in their distribution centers, disguised as more expensive inventory.
Exactly. The pain hasn't hit the profit margins yet. Now, Williams Sonoma utilizes an accounting method known as weighted average costing. Under this system, as they sell those chairs to consumers over the course of the year, the blended cost of all the inventory they hold hits their income statement as cost of goods sold, or COGS. Because the most recent inventory they imported was subjected to these new aggressive tariffs, the average cost of their entire inventory pool is dragged upward. This accounting method front-loads the financial impact.
Meaning, as they aggressively sell through this newly arrived inventory in quarter one and quarter two, they absorb the maximum concentrated hit to their profit margins.
Precisely. Howey explained that the mathematical pain of these tariffs will peak in Q2. Then, as they cycle through that highly taxed inventory and begin to replace it with theoretically better negotiated future shipments, the financial impact will naturally moderate and smooth out in the back half of the year.
And he didn't mince words about the specific policies driving this. He explicitly named the tariffs their models are absorbing. Section 232, Section 301, and Section 122 tariffs.
Yeah.
These are the sweeping federal policies governing everything from the importation of raw steel and aluminum to highly specific punitive trade policies directed at manufacturing in China.
Right.
And perhaps the most revealing detail about management psychology is that Howey confirmed they are not building any potential tariff refunds or government exemptions into their guidance. They are modeling the absolute worst case scenario. They assume they pay the maximum tax on every item, and they never see a dime of that money returned.
It is the pinnacle of conservative financial modeling. They are stress testing their balance sheet against the harshest possible macroeconomic environment. By modeling for zero relief, any positive development, a drop in fuel prices, an easing of trade tensions, a surprise cut in interest rates becomes pure, unadulterated upside to their margins.
The strategy reminds me of driving a highly engineered sports car through a dense mountain fog. WSM is sitting in the driver's seat, and they know the underlying engine is performing flawlessly. The cylinders are firing in perfect rhythm. That represents their massive Q1 beat, the 4.8% comp growth, the explosive brand heat of West Elm, and the 22% growth in commercial B2B. The vehicle possesses the capability to do 150 miles an hour, but they are driving headlong into a massive bank of fog representing the geopolitical wars, the $60 million in embedded tariffs, and a frozen housing market.
And in that scenario, the worst thing you can do is accelerate.
Exactly. Even though the engine wants to fly, you don't slam your foot on the gas.
Yeah.
You hold steady.
Yeah.
You keep your speed manageable, and you keep your foot hovering right over the brake pedal because you simply cannot see what obstacles are lying 2 miles down the road.
Yeah.
They are actively prioritizing absolute control and long-term survival over the reckless pursuit of short-term velocity.
That is the essence of reiterating guidance. It is maintaining absolute control while navigating the fog. But it is vital to note that even while operating in that fog, they concluded the call by forcefully reaffirming their long-term financial targets. They possess the conviction that when the macroeconomic fog eventually lifts, when interest rates normalize and housing turnover resumes, their underlying machine will deliver mid to high single-digit revenue growth and sustain operating margins in the mid to high teens.
And their confidence in achieving those massive long-term numbers is anchored in what they define as a digital first, but not digital only operating strategy, entirely backstopped by what they repeatedly refer to as their fortress balance sheet. They possess the liquid cash, the premium physical real estate, and the hyper-efficient digital infrastructure to simply outlast competitors who are over-leveraged, highly indebted, and currently drowning in that same macroeconomic fog.
Which brings us to the ultimate synthesis of this entire deep dive. When you step back and evaluate every mechanism we've unpacked today, the Williams Sonoma Q1 2026 earnings call transcends a standard financial report. It is a masterclass in ruthless operational discipline and strategic foresight.
They aren't simply a legacy retailer selling beautiful plates and perfectly textured throw pillows. They are conducting a symphony of extreme corporate complexity. They are seamlessly balancing an ecosystem of 10 distinct, aesthetically siloed brands to capture the consumer's lifetime value.
Right.
They're operating a flawless, technology-driven logistics network that successfully executes 7,000 large format in-home deliveries every single day. They are quietly dominating the massive, highly lucrative commercial hospitality space beneath the surface of their retail operations, acting as a massive corporate flywheel.
Yeah.
They are deploying advanced generative AI to actively lower return rates and optimize global shipping routes. And they achieved all of this, accelerating their growth and expanding their profit margins while navigating a structurally shrinking home goods market and absorbing tens of millions of dollars in heavy global tariffs.
It represents a profound level of execution that very few organizations on Earth are capable of sustaining.
So, connecting all of this complex machinery back to you, the listener. Why does understanding the mechanics of this specific earnings call matter for your life, your own investment philosophy, or the strategy you apply to your own business? This deep dive empirically proves that in a highly constrained inflationary economy, the businesses that survive and thrive do not compete on price.
No, engaging in a race to the bottom by heavily discounting your product is a guaranteed death spiral. The true winners in a hostile macro environment compete on service certainty, they compete on unmatched aesthetic curation, and they compete on absolute unyielding supply chain efficiency.
They possess the capability to make massive logistical complexity completely invisible to the end consumer, while ruthlessly optimizing the economics of that complexity behind the scenes.
Exactly.
Which leaves me with a final provocative thought for you to ponder long after this deep dive ends. We started this journey by examining that perfectly curated, serene retail living room display and exposing the massive, gritty global logistics war required to create it. The next time you walk into a beautifully styled room, whether you are visiting a friend's mid-century modern Gen Z apartment, helping someone move into a meticulously designed dorm room, or stepping into the breathtaking, serene lobby of a luxury hotel in Miami. Take a moment to think about the invisible global machinery that placed those objects there.
Yeah, think about the generative AI algorithms that mathematically predicted those exact design trends months in advance, the route optimization software that calculated the exact fuel burn required to deliver them, and the unyielding corporate strategy that made that aesthetic reality possible despite global tariffs and a frozen economy.
It forces you to look at the world differently, and it makes you wonder what other massive industries are hiding brutal, highly optimized operational complexity behind a perfectly curated, beautiful storefront.